Real Country 1430 AM and 1073 FM WRDN. I'm Brian Winnekins. Joining us this morning is Mac Marshall. He is Vice President of Market Intelligence with the United Soybean Board, and we're going to talk a little bit about those soybean markets today. And thank you to our broadcast sponsors, including Compeer Financial, Annabis Silo, Brevant Seeds, Matt Carl's our representative in Northwest Wisconsin, Wisconsin Farmers Union, and Osteoplastics. And Mac, well, thank you for joining us. At the beginning of 2020, or at least when the pandemic hit, I never thought I'd be seeing $11 soybeans, and we might be seeing $12 soybeans. What happened?
Well, I tell you, not just the beginning of 2020, but I think well into the growing season, I didn't expect that we'd see price levels, approaching $12. Certainly the highest prices we've seen since 2016. But markets change very, very quickly, and we've certainly seen that in real time over the last couple months for a confluence of factors, really. This rally we've had over the past couple months, a lot of it's driven by tightening of the balance sheets as we've had downward revisions to the U.S. crop size. Of course, we're still looking at an excellent crop. Probably the fourth highest on record at 4.17 billion bushels, I believe. But it's that supply tightness, I think, that has really been the catalyst in the price rally that we've seen, because it's happening against the backdrop of very, very strong demand. At this point of the marketing year, we're 11 weeks in. We are at a record export pace, both in terms of accumulated sales thus far, just over 16 million metric tons, really just to China, and for the world at large, just over 22 million metric tons out the door already, and another 28 and change lined up for forward sales over the balance of the marketing year. So really aggressive record export pace thus far, and that's part of what's driving some of this balance sheet tightness as well, as USDA has us pegged to have a record export year of 2.2 billion bushels, just under 60 million metric tons.
Mac, is there a concern? I mean, China's obviously being the big player in the room. I mean, they're bringing in so much so that Brazil now is having to buy beans from us because they sold them all to them. But a lot of times these purchases are for the upcoming marketing year. And is there a concern that in February or March or, something happens and China starts canceling left and right, and now what? I mean, yes, we have them on paper, but we really haven't shipped them.
Yeah, and I think it's a fair question, right? Because you have bills until you actually have them translated into physical exports. And I've gone back through and I've looked at the various positions we've had at points throughout the marketing year in terms of what our outstanding sales were heading into a marketing year and how that translated into actual physical exports. I think things still line up very well, and I think one of the reasons why we're seeing China come back into the market in a big way this particular year is certainly attributable to the phase one commitments that were made in February, or entered into force in February. We didn't have the opportunity to take advantage of phase one being in place during our peak export window after the last harvest, but we're seeing it now. But it's not just phase one that matters. I think that's where we really need to look at the fundamentals of what's driving China's import behavior. And that is, in large part, the recovery from ASF. There's some really positive news coming out of China in terms of herd recovery. Year on year, their total pig crop has rebounded, I think, by over 26% relative to this time last year. And the breeding inventory is up over 30%. So, still the total size of the pig herd is not where it was in early 2018 before ASF, took hold of China's pig production. But it's well on pace towards a fuller recovery. And as that segment recovers, certainly there's going to be more and more demand and need for soybeans to help underpin it. And I think, as you look at that first figure there in terms of aggregate all class herd size rebounding, That's great for demand in the present, but also seeing that really significant over 30% annualized growth in the breeding stock, I think also sets things up well going forward for additional incremental demand.
Talking with Mac Marshall, he's Vice President of Market Intelligence with the United Soybean Board. Mac, we're seeing these $11 approaching $12 prices. Farmers are also seeing those, and they're starting to make decisions for next year. Do you see a whole bunch of farmers deciding to get on this train and plant more beans, which obviously then would increase the supply, and that could affect the markets?
Yeah, I think if we go back to 2014, which is the last point where we were looking at the kind of balance sheet tightness that we see now, and balance sheets were even tighter then, and prices were even higher as a result of low carryout. I mean, we're under 200 million bushels expected at the end of this marketing year. For point of reference, back then we were under 100, and prices were over $14 a bushel. So the price signals are definitely there for area expansion. Back in 2014, going into that year, even with the high prices, I don't think there were a lot of expectations that we would cross that 80 million acre threshold, and we did. I think we came in, somewhere between 83 and 84 that year. And since then, we've seen figures, up in the high 80s, 88, 89 million acres. For this next year, the price signal is there. It's a favorable soy to corn price ratio, although corn prices are certainly rising as well, driven by a lot of the same dynamics that are underpinning soy right now, including the herd rebuild in China, as China has also come back in a big way for buying corn. So the signals are there for area expansion, and then naturally, as you have production, you're going to probably see some price moderation down the line. But right now, we're looking at the highest prices since 2016. Again, I think as you pointed out at the start of the year, nobody really could have seen that coming in the degree of balance sheet tightness that we've seen, because it's happening on both sides of the balance sheet, both on tightening on the production side, but on the demand side, that export pace remains strong. But it's also, I think, important to remember that we've got some really strong domestic disappearance as well. Crush throughout 2020 is significantly higher than 2019 record levels. I believe NOPA reported a single month record earlier this week. So the demand is overall very robust for soybeans, and we're certainly seeing that reflected in pricing.
That is Mac Marshall. He is Vice President of Market Intelligence with the United Soybean Board, all part of our NAFB annual convention coverage. I'm Brian Winnikins on WRDN.